Pretiorates Thoughts.
Cheap gold mines and a new chapter in the silver market. The growing dominance of passive investing has hit the mining industry harder than many observers assume. While active investors specifically seek out opportunities in individual stocks, in the passive world, capital only flows where indices and ETFs allow it to. Those not included in any fund remain in the shadows, often chronically undervalued, no matter how strong their fundamentals or prospects are. After years of stagnation, the mining industry has recently regained attention. With the rise in gold and silver prices, demand for mining stocks picked up. Since its low in spring 2024, the GDM Gold Mining Index has gained more than 170%, a spectacular recovery in less than 2 years. Nevertheless, the big money flow failed to materialize. The passive investment world, which now controls more than half of global investment volume, has ignored gold mines. A look at outstanding ETF shares speaks volumes. Despite rising prices, they have declined significantly. Apparently, many investors focused on physical metal rather than stocks, and after the sharp rise, many mining stocks are now likely to be considered too expensive. But this is precisely where the fallacy lies. Mining stocks work differently from traditional industrial stocks. They produce goods whose prices change daily, and with them margins, cash flows, and profits. This makes simple valuation metrics, such as the price-earnings ratio, unreliable. Value adjustments and price fluctuations distort profits and cause the PE ratio to jump. A low ratio is no guarantee of a favorable valuation. It often simply signals high production costs, impending margin losses, or simply that the deposits have been exhausted. The price-to-cash flow ratio, P/CF, is more meaningful as it excludes special balance sheet effects and value adjustments. It shows how much investors are willing to pay for a company's actual cash flow, and thus, whether gold mining stocks are considered expensive or cheap in the market. If the price of gold falls significantly, margins shrink and the ratio shoots up. Then the stocks appear expensive, even though their prices have usually already fallen noticeably. It is interesting to note that the top 3 producers such as Newmont, Agnico Eagle Mines, and Barrick continue to appear extremely cheap based on historical valuation metrics despite significant price gains. Central banks, on the other hand, continue to focus their interest on physical holdings. They have increased their gold reserves from around 30,000 to over 36,000 tons over the past 15 years. Gold now accounts for around 20% of their balance sheets, a clear signal that precious metals are regaining importance in the global financial system. If the report in the Jerusalem Post proves to be true, India could import huge quantities of silver in the future. The country has already significantly increased its purchases over the past years, and this could also be interpreted as a new chapter in the silver market. Even if the report proves to be premature, a closer ratio would be entirely plausible from a geological perspective. Silver is only about 15 to 20 times more abundant than gold, and is mined only about 7 times more frequently. The current market ratio of more than 80 to 1 seems unsustainable. This issue took a more informal perspective. In the next issue, we will return to market analysis in the usual form. We welcome your feedback. Let us know if you would like to read more background articles like this one. Remember that these thoughts are not investment recommendations, but only our opinion. For recommendations, contact your own investment advisor. Don't forget to give us a thumbs up below to help us keep creating this great content for you. And don't forget, if you register directly on our Substack website, you will receive my next thoughts at least 1 day earlier. Check out the Substack link in the description, and best of all, it's free. I wish you great success with your investments and see you for our next market update.